Tim, what happened Friday? What was that?
Well, payroll numbers are volatile. I mean,
Yeah.
Obviously, they jump around. So, 75,000 is down sharply from 200,000 plus last year, but we know how volatile the numbers are. If you look at the year-to-date average, it's 164, which, again, is down from 200 plus last year. I think that's plausible that there's been some slowing here, but I certainly wouldn't take one employment report literally, especially when we're not seeing corroboration of any major weakening in claims, which are basically hanging near 50-year lows.
Where else are we seeing signs of a possible slowdown, which has, the people that like to predict recessions are suddenly back in vogue, aren't they?
The manufacturing sector is clearly weakening, and obviously that's consistent with export numbers weakening, not just for the U.S., but globally trade has slowed sharply. So there's no question the manufacturing sector has shifted down here. But as far as the economy as a whole goes, I mean, if you're not seeing a clear uptrend in claims, the message is that there's no major slowing. I mean, obviously, that's something to watch. But at this point, I think the only sector that really clearly is slowing is manufacturing.
I thought construction, too, but then.
Construction numbers jump around. I mean, the housing numbers have been, if anything, on the positive side recently. Then the non-residential private construction has been a little weaker. The latest public construction numbers have actually been pretty strong. So, but housing itself is, not booming, but if anything, the numbers have been up over the last 4 or 5 months.
Don't you think the Fed is now kind of committed, at least? I mean, if you look at Fed funds, futures, or whatever you want to look at, it would be a big disappointment now.
Well, obviously the markets are in a way counting on the worst at this point. I think the Fed has made very clear, and they've encouraged the market to think that they're ready to step in if necessary. I don't think they've signaled that they're going to go next week. Not that they couldn't, given what they've said, but I think they're ready to move. But at the same time, as Williams said last week, they don't necessarily view the market as a great oracle. Just because the market is predicting it doesn't necessarily mean they have to follow.
But they seem to be following and being buffeted by stock market moves and by any weak data point, and I don't know.
Yeah,
is it social media's fault?
Although if you look at, the broad market, the S&P 500 as of Friday was down 2.5% from the all-time high, and of course has rallied more this morning. So, to the extent you're making an argument for easing based on financial conditions, as of now, it's not there. Now, you might say there's a bit of a chicken and egg. The markets are obviously counting on some Fed easing. But I think the Fed can take a little bit of weakening in the equity market. Because remember, the Fed doesn't want to see 200,000 plus per month on payrolls. They want some slowing in employment to stop the downtrend in the unemployment rate. But of course, the question becomes, at what point is that too much?
If you were in a vacuum and you saw where the averages were, stock market averages, and you saw where unemployment was, and you saw where the last print on GDP was, and then you didn't say anything else about tariffs or anything else, and you said, is the Fed in a hiking or cutting mode, you'd still think they'd be in a hiking mode. Yeah,
obviously, what they're signaling on inflation is a bit different from the past, and they're saying
the only way you can justify
that they want to go above 2%. They've changed their reaction function a bit on inflation, so it's pretty clear they're not going to tighten with the core PC at 1.6. But that said, yeah, you're right. With the growth numbers broadly, with the markets, there's clearly not a case yet, at least, to ease.
Normally, anyone that came, in a time machine forward, they would not understand that's what we're waiting for.
They have to be forward-looking, of course, and part of the backdrop here is this trade tension. And is that only going to get worse? We're seeing exports weaken. So they have to take that into account, but they do have to be forward-looking. But you're right. As of now, the numbers just don't seem to make the case.
I know a lot of people, Alec, that are 2750 for the S&P at the end of the year. They were there like a week and a half ago, and they thought they were smart. Now they're looking like, it's only, what month is it? Is it June?
June.
So it's June, and we're back almost to 2,900 on the S&P. What do you have a year-end target?
Well, I think the Fed's clearly signaling that
whenever you don't have a year-end target, or you do have a year-end target?
I think we're probably going to be higher.
Higher than we are.
Yeah,
right
and
now.
I think 2750 feels too conservative.
Okay.
We're late in the cycle. There's a lot of sensitivity to policy. Obviously, monetary policy is very supportive. A lot of this is psychological. When the market feels like it needs reassurance, the Fed's made it pretty clear from the chairman on down. It's there to do that, and the market responds very favorably. So if you're long equities and you know that whenever things wobble, you've got that insurance behind you, it doesn't really make a lot of sense to get out. Also with rates, you've got this TINA problem now. There is no alternative. If you look at a lot of areas of the market, whether it's Starbucks, McDonald's, waste management, companies are making all-time highs. You know, we had a bit of a stealth bear market where it didn't feel like it because some of the bigger companies that hold up the averages were doing fine. But the average stock, you know, got hit pretty hard over the last couple of years, and we're seeing a lot of that reverse. So it feels like there's more risk being out of the market. Obviously, the big metric people are watching, and it was great that you just had Secretary Mnuchin, but it's going to be that G20. But if we get more policy support on the trade front, like we have on the monetary front, you know, Katie bar the door, I think this market's going to really challenge those highs.
It's nice that our antiquated version that, you know, zero was as low as you could go. Thanks to Germany and Japan and everybody else, we know that that's not even, it's new math. We can go negative. Plus, we can print as much money as we want with the modern monetary.
I'm sure among the Fed is that just saying they stand ready could do part of the job, and they don't actually have to do anything.
Since
at least for
December,
a while.
Yeah, it worked since December.
If
So
you have
okay,
a bazooka in your pocket, you don't.
Yeah, you can just sort of.
Right. I mean, if you get good news on trade and better economic data by July, when people are currently thinking they're going to cut, people won't care if they cut because we will have gotten better news. The key is if things get shaky, investors get nervous, the outlook gets murky. They're there to be supportive, and I think the Powell Fed is more market friendly than, you know, any Fed I can remember.